The Wall Street Journal and multiple other outlets are reporting that the video game retailer GameStop is actively preparing a bid to acquire the e-commerce giant eBay. Yeah, you heard that right. The brick-and-mortar store where you used to trade in your entire console for like $3 in store credit is now aiming to buy one of the foundational pillars of the internet marketplace. It's a headline that literally makes you do a double take, and it's setting the entire market absolutely on fire right now.
Okay, let's dive into this. The undeniable math of the situation is just staggering. Look at this massive 4-to-1 size disparity. GameStop is currently sitting at a market capitalization of roughly $11 to $12 billion. eBay, on the other hand, is a complete behemoth, trading at a valuation of around $45 to $46 billion. So we're looking at a classic David and Goliath scenario here, which establishes a central mystery that has everyone from Wall Street analysts to casual observers completely scratching their heads, like how exactly does the smaller fish eat a fish 4 times its size?
Section 1. Financing the impossible. Let's look at how GameStop could actually pull this off. How does a $12 billion company buy a $46 billion company? That is the exact question currently setting financial message boards and Reddit communities totally ablaze. And you know what? If you're looking at this and feeling super skeptical, you are entirely validated in that skepticism. I mean, it seems physically impossible on the surface, right? You don't just walk into a bank and ask for a $46 billion loan to buy a company way bigger than your own. But, well, in the high-stakes world of corporate finance, size is just one variable in a much larger equation.
To really understand how this works, we have to look at a mechanism known as the leveraged buyout, or an LBO for short. Think of it kind of like this. Imagine you want to buy a massive, expensive house, but you just don't have all the cash. Instead of using your own money, you essentially use that massive house itself, its value and its potential rental income, as the collateral to secure the loan you need to buy it. You are literally using the target's own assets to fund your purchase of them. It's an incredibly aggressive financial maneuver, sure, but it's actually a standard playbook in corporate acquisitions.
And this brilliantly illustrates the playbook that analysts and retail investors believe GameStop is putting together right now. The working theory basically breaks down into 3 distinct steps. First, GameStop throws its own massive cash reserves into the pot. Second, they partner up with heavyweight private equity firms, the guys who specialize in funding these massive transactions. And third, they issue a mountain of debt, securing it against eBay's highly reliable, billions of dollars a year cash flow. Essentially, eBay pays for its own acquisition over time. So the absolutely crucial point here is this staggering number, $9 billion. GameStop is not walking into this empty-handed. Over the last few years, they've quietly built up a massive war chest of $9 billion in cash and marketable securities, all while maintaining zero long-term debt. Actually, that pristine balance sheet is exactly what makes them such a uniquely attractive operating partner for those huge private equity firms. They have the upfront capital to initiate the deal, which makes the impossible suddenly look, well, highly plausible.
Moving on to Section 2, the billion-dollar motivation. Let's talk about Ryan Cohen's personal stakes.
This jaw-dropping figure tells you pretty much everything you need to know about the motivation behind the scenes. Earlier this year, GameStop actually revised CEO Ryan Cohen's pay package. Get this, if Cohen can aggressively increase the company's value and profitability, specifically hitting a massive target of driving GameStop's market cap to $100 billion, he stands to make up to $35 billion in stock-based compensation. $35 billion? That is a historic, literally world-altering incentive. And to reach a $100 billion valuation, GameStop simply cannot just sell video games anymore. They have to acquire massive new revenue streams.
Just listen to this quote from an interview Cohen gave back in January. "There are a lot of diamonds in the rough that have sleepy management teams. I didn't fix GameStop to stop there." Wow, that is aggressive. That's a CEO openly signaling that he is hunting for acquisitions. By calling management teams sleepy, he's heavily hinting that he views companies like eBay as prime targets. In fact, analysts suggest he's more than willing to launch a hostile takeover by taking his offer directly to eBay shareholders if the board rejects him.
Section 3, dominating the collectibles market. Here is GameStop's master plan.
This acquisition would fundamentally shift GameStop's entire business model. They want to pivot from being a struggling brick-and-mortar chain into a fully diversified digital powerhouse. But you know what the real secret weapon here is? Collectibles. GameStop already has a partnership with PSA, the premier trading card grading service. And eBay? Well, eBay is the undisputed king of the secondary market for Pokemon cards, sports memorabilia, and high-end collectibles. By acquiring eBay, GameStop wouldn't just participate in that ecosystem, they would instantly dominate it, capturing the fees on millions of high-margin transactions every single day.
Which brings us to Section 4. The community reacts.
Let's look at Reddit's deeply divided stance on all this.
Now, what's really interesting about this slide is the sheer disbelief out there. Over on the Rash eBay subreddit, the reaction is a wild mix of complete confusion and straight-up mockery. For people outside the financial bubble who mostly just see GameStop closing physical retail stores, the idea that they could purchase a tech giant like eBay seems like a total joke. They look at that 4-to-1 size difference we talked about and simply reject the premise entirely.
But right beneath all that disbelief is a very real, very palpable fear. Think about it. If GameStop executes a leveraged buyout, they're going to take on tens of billions of dollars in debt. And how do you pay off that debt? You increase revenue. For eBay sellers, the terrifying mathematical conclusion is that GameStop will be forced to massively hike seller fees to service that enormous loan. Sellers are already panicking that their margins are going to be completely wiped out just to fund Ryan Cohen's financial masterstroke. On the complete opposite end of the spectrum, though, you have the notoriously bullish retail investors on the Reddit Superstunk subreddit. They are definitely not panicking, they're meticulously analyzing the balance sheets. They see the $9 billion in cash, they deeply understand the mechanics of private equity partnerships, and they view this as the ultimate vindication. To them, it's not a joke at all. It's a perfectly executed, calculated, leveraged buyout that takes full advantage of GameStop's uniquely pristine financial position.
Which leaves us right here. Whether this hostile takeover actually succeeds or fails, the very fact that it's being seriously prepared changes absolutely everything. So what happens to the future of e-commerce when a company that was written off as a dying meme stock suddenly wields a multi-billion-dollar financial war chest and has the aggressive ambition to swallow an industry giant whole? It is an unprecedented power shift unfolding right before our eyes, and the ripple effects are going to be felt across the entire market for sure.